Hello and good afternoon. On behalf of myself, Michael O'Reilly, and the entire team, we are very excited to bring to you what we believe is an excellent multifamily investment opportunity located in the Dallas-Fort Worth Metroplex area, consisting of 137 units called Maverick Oak Lawn. I'm going to first get a quick housekeeping note out of the way. I'll read a brief, abbreviated confidentiality disclaimer. The information contained in this presentation is considered confidential. That is intended solely for the individuals with whom it's delivered. The circulation of this document or disclosures of content to any other parties is expressly prohibited and is solely for the use of prospective investors to determine the level of interest in Maverick Oak Lawn investment opportunity. This offering is under SEC Regulation D, Rule 506B, and is only for sophisticated and or accredited investors who have a pre-existing and substantive relationship with one of the sponsors on the project. We have quite a bit to cover this evening, so we'll get to it. We're going to be covering the executive summary. We're going to meet the team. We're going to be looking at the market and the submarket overview. We're looking at multifamily sector outlook, property overview, rental comps, our business plan, our CapEx strategy, the financial analysis, risk and exit strategies, timeline and next steps, and we're going to wrap it up with some Q&A. So we'll get right to it. The executive summary. Maverick Oak Lawn is a 137-unit B-class apartment community in a premier location near Cedar Springs and North Dallas Tollway, and surrounded by affluent neighborhoods such as Uptown, Highland Park, and the Design District. The property is ideal location for young professionals as it backs up to the medical district and is less than 2 miles drive from downtown, with access to anywhere in DFW area via Interstate 35, Highway 75, Interstate 30, and the North Dallas Tollway. With strong location comes strong development, and within the past 5 years, over 4,500 Class A multifamily units have been built within 1 mile of Maverick, including the Lucas, which is directly next door at 386 unit community, built in 2016. Current residents of the Maverick enjoy a pool, a lounge area, a picnic and coffee area, dog park, and access to affluent dining and retail options. Our projected outlook on this investment is 100+% returns, modeled on a 3 to 5 year investment time horizon, 21+% ARR, 17+% IRR, and $75,000 is our minimum investment criteria. Our total purchase price was $25,550,000. This property was built in 2 phases. First phase was built in 1970. The second phase was built in 1972. We have a purchase cap rate of 4.1 and a reversion cap rate, or an exit cap rate as it's referred to, as 5%. Our physical occupancy is 97%, and we are pre-leased to capacity to 100%. Our total equity raise will be $9.7 million, and our division of partnership structure will be 80-20 split, 80% going to limited partners and 20% going to the general partners. A couple highlights on this property. In a 1 mile radius, the average household income is over $110,000, with a 10% population growth projected for the next 5 years. This is an extremely clean asset. Current ownership has spent over $2 million in the past 2 years. 81 units have been retrofitted with washer and dryer connections, and 60% of the units have been upgraded. And now we'll meet the team. On this page is myself, Michael O'Reilly, and my wife, Denise O'Reilly. We are managing members of Westward Multifamily. We are real estate investors, syndicator operators that have held the titles of GP, KP, and LP in 1,172 units across Texas and Arizona. We are owner investors in senior assisted living communities and co-directors of a nonprofit corp advocating for the quality of living and care for seniors. Denise is a 19-year real estate professional. She has experience in sales, property management, investing, and project management. I'm a 23-year Wall Street veteran, experienced in trading with family offices, hedge fund, high net worth individuals, and institutions. Our other team member, John Way, he's a founder of Astute Equity Holdings. He's a multifamily investor, syndicator, operator, GP in 304 units, LP in 317, all in Dallas. He's a 20-year experience, certified financial planner and wealth advisor. Our next team members are Rebecca Moore and Warren Buller. They are managing members of Starboard Equity and Red and White Investments located in Dallas. They're presently GPKP LPs in 2,062 units with an additional 934 units that have gone full cycle across Texas, Oklahoma, and Colorado. Rebecca holds a doctorate in philosophy and clinical psychology with the forensic emphasis from California School of Professional Psychology in 2004. And Warren is a retired captain with the U.S. Navy. He served from 1985 to 2018 with a Master's of Arts from the National Security and Strategic Studies of Naval War College in 2002. Warren, on behalf of myself and the entire team, I just want to thank you for your dedication and service to our country. Next is Ari Patera. Ari is a co-GP with 761 doors in Dallas and Houston. He's passively invested in over 1,200 units in multifamily. He's owned several single-family rentals and investments, fix and flips. He's well-versed in real estate notes and currently works as a real estate professional in Dallas. Over 18 years prior, he was a project manager experienced in IT software and mortgage-related industries. Jerry Tang is an emerging multifamily real estate deal syndicator, investor, and operator with 15 years of global experience in building and scaling exponentially in tech and operational complex businesses. He is a GPKP LP in 1,734 units across Texas and Oklahoma. Currently the COO of Dandy, a venture-backed technology company in dental and healthcare industry. Prior to that, he was the VP and global head of operations for Flexport. He built, scaled operations from a 50-person startup to a multi-billion-dollar enterprise with 2,000 plus employees worldwide. And now I'm going to pass it on to my wife, Denise O'Reilly. She will talk market overview.
Thank you, Michael. As Michael mentioned, I'm going to speak about the market and why we choose to do business in Texas. So what is it about Texas? Texas has grown into an economic powerhouse. As of 2021, Texas surpassed the country of Brazil to become the 9th largest economy by GDP worldwide. Texas is also the #1 US exporter. It is the largest energy production state in the nation. It's a leading job creator, creating almost 700,000 jobs in 2021 alone. It has no personal or corporate income tax, and it leads the US as the #1 destination for corporate relocation from other states. Next slide. 54 Fortune 500 companies are headquartered in Texas. And why is Texas such a popular choice for corporate relocation? The key drivers are the pro-business regulatory environment, access to talent, and favorable tax laws. The combined Texas tax rate is 21%, which is amongst the lowest, if not the lowest, in the United States. The industrial giant Caterpillar is the latest Fortune 500 company to announce a move to a location in North Dallas, 15 minutes from the property, and will create hundreds of additional jobs for the local economy. Now, this slide talks about net migration and population growth. Texas also ranks first in another metric, the number of net domestic migrants. This chart shows 785,583 people moved to Texas between July 2020 and July 2021 from the West, the North, and the East. Texas also has the highest retention rate of any state. 3,800 more people move into Texas than leave every single week. In fact, if our family moved to Texas from our home state of California, we would increase our income by a whopping 34%, since Texas has no income tax. Next slide. Dallas-Fort Worth Metroplex, or DFW. The 2022 Dallas, Texas job market is booming with opportunities in a variety of industries and at all different salary levels. The Dallas-Fort Worth Metroplex is one of the fastest growing regions in the country, and that growth is reflected in the job market. There are substantial population gains. It has one of the largest employment markets in the nation, above average job growth. It's recession resilient, houses 21 of the 54 Fortune 500 companies in Texas, is a major distribution hub, and as far as multifamily investing goes, is landlord friendly. Next slide. A recent CBRE report names Dallas as leading the nation in multifamily real estate investments. The rise in demand has been fueled by household formation, job and wage growth, and sharply rising home prices. Next slide. Now I'm going to pass it over to Michael, and he's going to talk about the multifamily sector outlook.
Thank you, Denise. Right now in the current inflationary environment, multifamily apartments provide a phenomenal hedge against inflation. The rent growth has been through the roof, an average of 18% over the last 22 months in Dallas alone, with considerable rent growth continuing in 2022. There's also a quick opportunity to raise rents to market fairly quickly, seeing that leases are generally a year or less, allowing apartment operators to keep up with rental growth and continue to maximize income. There's no investment that is recession proof, but we believe that multifamily is recession resilient. The apartment sector overall is poised to weather recession well. An economic downturn could steer more potential renters to apartments instead of for sale homes or condominiums. Recessions lead to layoffs, foreclosures, and other economic hardships. In these times, people look for lower cost housing. It is downsizing caused by demands for apartments to increase. After all, shelter is a basic need. This, coupled with the decreased supply of workforce housing, make those investing in commercial multifamily real estate uniquely poised to benefit in both recessionary and non-recessionary environments. Next slide, please. So, financial headlines. You can't really turn anywhere these days without hearing a headline from the stock market or the crypto markets or even the residential real estate markets. The stock markets is generally a reflection of goods and services that are bought and sold throughout the world. Crypto markets are highly speculative. Real estate, residential real estate, to be more specific, is potentially going to be challenged in the near future, but this plays into the hand of the multifamily market. Even in the current economic climate, multifamily fundamentals continue to remain strong and will continue to until supply catches up with demand, which will be many years to come. Additionally, we have seen volatility creep back into the public markets. And at this time, we feel that multifamily investing can be a defensive investment opportunity, allowing investors a safe harbor, if you will. It is a great capital preservation play while still receiving handsome returns with tax advantages. Next slide, please. So their outlook, as I mentioned a couple minutes ago, the rental growth has been phenomenal, over 18% in the last 12 months, and it's projected not to be quite as strong, but still double digits return in 2022. The average occupancy across the nation stands at 96%, so our inventory is just about full. Renters, with the rates moving up, are increasingly being priced out of home ownership, so that bodes well for multifamily investing. And the median household income, the median household price has jumped to 18.1% higher than just last year alone in Dallas. The housing shortage and the lack of adequate constructions, we have acute housing shortage between 2 and 5 million units that are necessary, and there's just not enough development underway in our housing needs. Apartments offer compelling and long-term return potentials. First-year yields may not exceed financial costs, but housing shortages exacerbate an aging population, and supply shortages create strong rental growth, potentially beyond 2022, leading to greater returns over the future time horizon. Now I'm going to pass it on to Rebecca Moore, who is uniquely qualified to talk about our submarkets.
Thank you, Michael. All right. Warren and I, when we first moved to Dallas, moved to the Oak Lawn area, and this is this fantastic area. You'll notice that right between the red medical district and the blue Oak Lawn, where this map has it, is the Maverick in the white space. But yet these two areas blend together, as it is called the Maverick at Oak Lawn. Oak Lawn has the Perot Museum, the Clyde Warren Park. It has the American Airlines Center, the Katy Trail, which is fantastic. It has many great restaurants and bars. It is just the epicenter of fun for people there in Dallas. The Highland Park area is like Beverly Hills, or maybe some other folks from LA will know when I say San Marino area. It's just gorgeous. Again, very, very high end. The medical district, of course, is all of the hospitals, and it has jobs galore. The Children's Medical Center as well. The design district has the renowned designers, every designer that you can think of, and lots of art galleries, shops, and restaurants there. The downtown area has the financial district as well as every business in Dallas. This is a phenomenal area for our apartment building, as well as an A-class, and many other A-class buildings are being built right near where the Maverick is, giving us a great opportunity to bring in new tenants that might not be able to afford an A-class, but can come into our B-class and be able to afford this place to live. Next slide, please. So again, in this area, it is a place where the young people starting out are going to be able to be attracted to this great culture of downtown Dallas, the nightlife and the restaurants. So again, Warren and I loved it, and I think that it will be a wonderful place for people to want to live. So we'll move on and have Denise talk about our next subject.
Thank you, Rebecca. Property overview. So a little more about the property itself. The 137 units consist of 14 buildings in 2 phases, has 1- and 2-story townhome and single level unit types. It has mainly pitched roofs with small flat transitions in the middle, and is serviced by a combination of individual HVAC units in phase 2, and phase 1 has a chiller system, which was replaced recently in 2019. Population projection by 2026 within 5 miles is 408,660. The average household income within 3 miles is 128,978. And median income within 1 mile is healthy at 77,059. Current rents are priced below market, which we will raise to market as part of our business plan. Next slide, please. So I'm going to talk a little bit about the amenities and features. Common area amenities include a sparkling swimming pool, an outdoor lounge area, gated access, a large dog park, 2 on-site laundry facilities, and an excellent location near shopping, dining, and entertainment, as Rebecca spoke about. The unit amenities include private patios or balconies, large closets, many of them walk-in closets, fully equipped kitchens, separate dining areas, and extra storage. Rental trends. These charts illustrate rental trends for 1- and 2-bedroom apartments. In the chart, the blue line represents the Maverick Oak Lawn apartments. The yellow line represents Dallas-Fort Worth 2- to 4-star apartments. The green line represents Northwest Dallas 2- to 4-star apartments. And the orange line represents comps or comparable rental units. What is represented here is that the blue line, Maverick Oak Lawn Apartments, is below the rental trend lines in most of 2021 and 2022, meaning rents are currently below market and there is a real opportunity to push rents up to market just on an organic level prior to rehabbing more of the classic units. Next slide, please. Unit mix and pro forma rents. This chart shows current market rents and pro forma rents, or the amount we plan to raise rents to under our business plan. The average rents range from $1,205 for the smallest unit to $1,570 for the largest 2-bedroom townhouse unit. We plan to raise rents through organic rent increases and converting classic units to premium upgraded units, which represents rental increases averaging 8%, 4% being the lowest increase, all the way up to 17% for the highest increase. Next slide, please. Now I'm going to pass it back over to Rebecca, and she's going to talk about our business plan and CapEx strategy.
Thank you, Denise. In order to raise these rents and do our business plan, these are some of our business partners that are helping us get there. Of course, most of you have heard of Marcus and Millichap with Al Silva and Ford Brawley, who we've worked with to get this property. We are using Calliser as our lawyers, Ramey King for the insurance, BWE. Most importantly here is Fairmont Management Company. They are the managers that we will be bringing on. Of course, Kensington and Vanguard and Omni Assessments who assess the property. Next slide, please. Here I'm going to outline our business plan and then go into more detail as we go. So first, we're going to push rents to the current market standard. We're going to take advantage of the momentum of the submarket rents that have grown 18% in the past 12 months. Lease tradeouts only average 10% over the same period, so the immediate loss to lease can be burned off. The average rental upside of 221 per unit a month. We're going to implement a premium unit upgrades, increase rents to match nearby comparable competitors at a $325 delta, and the A-class property next door to the Maverick is $650 plus, allowing the Maverick to implement the premium upgrades to be an affordable competitor. We're also going to implement new income streams, such as covered or reserved parking, a technology package, enclosed patio yards, etc., are all common at the similar properties, but have not been implemented at the Maverick Oaklawn. We'll continue to add washer and dryer connections and washer and dryer machine rentals. Next, we'll address all the deferred maintenance, which might include, most specifically, roof replacement. And that's where Warren and I come in as a valuable asset manager, as we've done this at another property. Also plumbing, HVAC, a little electrical, some exterior painting and carpentry, as well as addressing small things at the parking lots. We will also optimize management and operations. We'll be bringing in the new Fairmont Management Company to optimize and audit the current operations and increase operational efficiencies. Next slide, please. So all of this contributes to the creation of value on the property. So we've estimated about a $6 million total value creation. So again, this is in the added reserved parking and the carports. As you'll see, we're going to do about 55 altogether reserved and carports. With the new laundry units that we will implement, this will add more, about $48,000 a year. For total revenue. Adding the private yards on approximately 50 units will create about $30,000 in revenue per year. The tech package, we believe that speedy internet will create 31,000, therefore $40 per unit. So that added value to the building. Upgrading the units will also add another $100 to the rent for every unit. That will bring in about 164,000 per year, creating value. Also, as you see on the bottom, other possible value creation items, some water savings, potentially 32% additional savings, and activating solar panels that are not currently in use could be very cost effective for the electrical. So these are all ways that we can add value. Next, the CapEx expenditure strategy. Next slide, please. Here, as we mentioned, we will audit and optimize the management and efficiencies throughout to increase the overall savings and help increase the NOI. The roof replacement will be our major CapEx. And what is great is that Warren and I already have experience replacing roofs at our Jane Lane property there in Dallas as well. So we feel very comfortable replacing the roofs. We've done it before and we'll do it again. The boiler and chiller are in great shape here at the Maverick. It is, the chiller has 20 years on it. That is going to do great. The boiler has another 10 years of life. They just need a few repairs. So we're good at that. The plumbing and the electrical need some small repairs, nothing big, as well as paint, carpentry, and other cosmetic improvements. We will continue again with these premium upgrades. Approximately 45 units are ready to be upgraded, and that means having some washer dryer connections put in, and the upgrades of granite, some stairway railings will be put in, and new faucets and fixtures. We will implement, again, utility and water conservation to reduce expenses and increase bottom line savings. And we will implement multiple new streams of income, such as the covered parking, the reserve parking, the patio enclosures, the technology package when the cable contract expires in 2 years. Next slide, please. So again, with the unit upgrades, the Maverick at Oak Lawn currently has unit upgrade program that includes washer and dryer connections, paint, flooring, cabinet faces, complete replacement of fixtures, black appliances, backsplashes, metal railings on the staircases and balconies, tub resurfacing, granite countertops, black 1/4-inch trim, and 2-panel door installation throughout. 81 units have undergone its full upgrade and are achieving an average premium of $263 above market rents for these upgrades. There are 56 units remaining left to upgrade, which upon completion would add approximately $164,000 per year in additional income. Here you can see the breakdown of each type of unit. Next slide, please. So here again is the classic units with the large wooden railing and the resurfaced countertops there in the bathroom. Next slide, please. And the renovated units here, you can see the nice railing on the stairway, as well as the granite countertops and the black appliances. Next slide, please. And here is the rehab breakdown, just to give you an idea of the deferred maintenance, here with the roof replacement, amenity of the exterior improvements, such as an upgraded dog park, and again, as mentioned, the paint and the yards, interior upgrades as mentioned, and the contingency funds of the unforeseen. Next, and now I'll turn it over to John to fill us in on all the financials.
Thank you, Rebecca. All right, financing summary. So with this Maverick of Oaklawn, we are planning to engage in a bridge loan to execute our business plan. As you mentioned, as actually Michael mentioned earlier, the total purchase price is $25,550,000. We will be totally financing 19.837 million. Now, part of that 19.837 million, about 1.3 million, as Rebecca mentioned in the previous slide, is going to be capital expenditure. So initial funding of the loan will be about 18.5 million, roughly. The bridge loan, the reason for the bridge loan is so that we have a flexible exit. So it's a very flexible loan, in that we're only committed to the loan for the first 15 months. Full term IO essentially means that it's interest only for the term of the loan, for the full term. And the term is 3 + 1 + 1. And what that means is 3 years interest only, plus 1 year plus 1 year of extension options at the end of year 3, at the end of year 4. Protective upside on rate hikes. So what we are planning to do is that you see that there's an interest rate variation of 5.61 to 6%. So during our due diligence process, as well as the closing timeline, we are planning to buy a rate cap, interest rate cap, to limit our upside risk in terms of the hikes in the federal government, Federal Reserve. So our maximum rate potentially will be at 6% at the very top. It could be actually as low as 5.61%. Prepayment penalty, there's a 0.25% prepayment penalty on the exit. There's a 0.25% on the extension at the end of year 3, at the end of year 4. There's a 1% origination fee. Now these are all industry averages. Replacement reserve, we have negotiated with the lender that they will waive our replacement reserve for the first year. Our lender is Angel Oak Commercial Lending. They are actually located, a balance sheet lender located out of Atlanta, Georgia. The loan type is non-recourse bridge. So with the basic summary, scenario for a financial summary. So this kind of shares with you our basic underwriting for holding the property for 5 years. So as you can see from the left to the right, asking price, purchase price, sale price is at 25.55. All in, including rehab budget, part of the rehab budget is 26.5. Cost per unit is about $186,000 per unit, roughly. We are looking at all the way to the bottom is the total initial investment is 9.7 million. That's the amount that we are planning to raise from our initial capital down payment. The total return for this project over a 5-year base case scenario is 111.63%, as Denise mentioned earlier. 5-year average cash flow, roughly about 4.64% on average. Now, the next slide actually shows you the 5-year cash flow, how that cash on cash comes in play, and how it's being averaged out over the 5-year period, and also how we get to the return on an IRR of 20.7%. So the cash flow on a yearly basis, if you look at year 1, it's 1.9, year 2, 3.6, year 3, 5.7, year 4, 7.3, year 5, 12.2. So as we implement our business plan in year 1, hopefully within year 1, or maybe spreading out into year 2, the income goes up organically, but also us implementing the business plan will increase the income by forcing appreciation and also forcing the income to go up as time goes on. So even you see a average cash on cash of 4.64, you're looking at a gradual increase in terms of cash flow from year 1 to year 5. So this is a 5-year cash flow model for a base case scenario. So when we look at the financials, we always want to look at, what's possible within this project. So when we look at a reversion cap rate, an exit cap rate. So the exit cap rate essentially helps us determine what the sale price will be in year 3 or year 5. Also, what will help us determine our exit sell price is also our operating income. See the net operating income? That's also what will help us determine our sell price. So with this property, we feel that using roughly about 5% on an exit cap rate for a B-class property in Uptown Oaklawn is fairly, actually very conservative. In year 3, we're looking at a 1.75% equity multiple if we were to sell. Now, if the market's really, really bad, if something were to, if the market in Dallas Oaklawn is really, really, really bad, we maybe see a 5.4% reversion cap rate. But even then, we're still at a 1.5 times equity multiple. Let's say in a very likely scenario, potentially a 4.55% cap rate. In year 3, we're looking at 2.17 times equity multiple in year 3. Now, if we were to hold the property for 5 years and execute our business plan and the increases in rents and all that, year 5, we're looking at for 5% exit cap, we're looking at 2.45 times equity multiple. 5.4% reversion cap, 2.18%. And 4.55, we're looking at almost 3% equity multiple, 3 times equity multiple. So the upside potential is that we are planning to refinance in year 3. Since right now we have a bridge loan, we are planning in year 3 to refinance, potentially sell or refinance in year 3. If we do refinance in year 3, we're planning to refinance into a more stable debt, maybe Fannie or Freddie debt that has much lower rate. And we're able to take out equity to distribute to investors in year 3 if we do not sell. The break even, we wanted to see sort of stress test this property in that we want to find out what is the absolute break even in year 1 if we were to in terms of economic vacancy. So that number is 27%. Fee disclosures. So we wanted to share with you that in terms of the asset management fee on an ongoing basis is going to be 1.25% paid to the general partners. Carried interest. So as mentioned earlier, it's any kind of distribution of profit. It's going to be 80% to the limited partners and 20% to the general partners. Acquisition fee, about 1.5% paid to the general partner at closing of escrow. No refinance, no disposition, no loan guarantor fee, and no construction management fee. And we would like to share with you that we as a GP team really believe in this property, and that we are investing our own money, about $1 million of our own money into this deal. And it's about more than 10%, a little bit more than 10% of the total equity that we're planning to raise for this project. So the projected return in base case scenario, I think I reviewed that in a couple slides earlier. 111% roughly total return over 5 years, 4.7% roughly on a cash on cash basis. Now this is on average, right? So as I mentioned earlier, it's average cash flow. So the cash flow will build up from year 1 to year 5. So as you can see on the bottom chart here, it shows you if we actually even out the cash flow in a base case scenario, you'll get 4.7% per year. But in reality, in most cases, in likely scenario is that your cash flow will be 1 to 2% in the first year, and then it keeps on building up over 5 years. And then total IRR in terms of investor IRR is 21% over 5 years. Yearly. Now, if we were to refinance, so what we did here is to share with you in terms of the cash flow and the return, how you get your money back and how where the returns are coming from. So if we do a refinance in year 3, what happens is that you see that there's a spike in cash flow, cash on cash in year 3. In that if we do a refinance, we will refinance out probably 7 to 8 million if everything goes as planned and the reversion cap rate is at 5 roughly. We will cash out about 7 million roughly in terms of cash out refinance. And then with that cash out, we distribute back to investors 61.8% of their original capital, and also continue to fulfill the distribution over year 4 and year 5. But upon exit, what we're planning to do is also in year 5 is to distribute the profit on sale. So a little bit higher of a return rate, but then the primary difference is going to be the cash on cash in year 3, and that pretty much raises the cash on cash from 4.6% to 13.17% because of the refinance. So with that said, I'll turn to Warren to kind of go over our exit strategy and the remaining topics.
Yes, John, thank you very much. John's presented some of the projected returns, and you've recognized many of the financial spreadsheets that we use with our very conservative underwriting. But the returns really are based on the prevailing economy when you arrive at certain milestones. And the first milestone for our business plan is at 3 years. You can see the first exit strategy there, labeled number 1 there, is that we could sell this property at year 3 free and clear, meaning we're able to do so without prepayment penalty. And we project, if the economy is where we think it will be at year 3, something on the order of 1.76x on your original investment, a pretty good return in just 3 years. John also presented the refinance option there. And the benefit of refinancing is that there's a couple things. One, it results in a higher cash on cash, a little bit north of 13% in this case. But it begins to get into what I call investor nirvana. When you're able to refinance and get some or all of your investment capital back from your initial investment, and particularly if you get all of it back, if the interest rates and the economy afford us to do that, then you have essentially the same equity share in the property, but you have no capital still invested in the property, no skin in the game. You're dividing by 0 now, and that's known as an infinite return. So every dollar you get in distribution, the value add dollars you get on the sale of the property, it's all essentially an infinite return because you already returned your capital. And we'd love to be able to do some or all of your capital return to you at year 3 should the interest rates afford the opportunity to refinance. There's actually a third option, and it goes to the projection example for the base case that John just talked about, the hold and sell in 5 years, and you'll recognize those numbers. If we do nothing, we exercise the 3 + 1 + 1 on our bridge loan, then in 5 years we sell, we project that you'll be in the neighborhood of 111% return and an average cash flow over 5 years at 4.64%. So those are really the 3 options. Sell it in 3 years, refinance in 3 years and hold it maybe another 2 years, and then sell, or do nothing and exercise the 3 + 1 + 1, which arrives at 5 years and a pretty decent return, I hope you'll admit, 111%, not too shabby. Next slide, please. This is perhaps the most interesting part of the whole session. I think that's why they asked me to talk about it. The sexiest part about investment in apartments is the tax benefits. And right about now, many of you are thinking, but taxes aren't sexy and they're not fun to talk about. Cost segregation, the study that we have here currently, if you run from the column on the left-hand side, the investment amount, and 100,000 is a good round number. We can do math with 100 in our heads. If you run very quickly through the algorithm that we have depicted here, which is kind of a big picture, high-level algorithm for the calculation of the bonus depreciation that you might expect in year 1, running from left to right, $100,000 will earn you about a projected $63,159 in bonus depreciation in year 1. Well, you're no dummies. You can do the math. That means a 63% return on bonus depreciation. Warren, normally we're accustomed to seeing those numbers a little bit higher. I'll explain that we have just the one preliminary study. We've got two other vendors that we've worked with extensively here in the DFW Metroplex that I believe are a little more aggressive with the way that they value land. And then the remainder of the depreciation discussion on the property, I think we're going to see that go north of 85% or more. But the big takeaway and what we want to leave you with is that 2022 is the last year in the bonus depreciation season where you will earn 100% bonus depreciation, projected to drop to 80% next year, and then continue to drop in 20% decrements until bonus depreciation evaporates, or the administration that happens to be in the White House at the time decides that we need to give real estate investors another incentive to stay in the game, which I'm confident will come, regardless of whom it is, whichever political party may be in control. They recognize the importance of real estate investing to our economy. They'll come up with something to replace or re-enthuse cost segregation and bonus depreciation in the future. But we do know that 2022 will be the last year for 100%. So you want to make sure that you take advantage of that. We're going to go out and try to find a more aggressive cost segregation study to move that needle well north of 63%. Let's move the slides into the risk and mitigation discussion here. A lot of our investors now are asking us, where do we think the economy is going? How do we think our properties are going to perform in the current economy? It's a mess out there. We're not really sure that we should be doing anything. We should just wait and see what we got. And I'll tell you, I think it may be attributed to Warren Buffett, but it's at least somebody that's made millions, if not billions of dollars in real estate. The best time to buy real estate was yesterday. The next best time is today. You just have to find the right lens through which you need to look at the current economy and make those current economic conditions work for you. And currently, that best model for us is the bridge loan, which enables us to, perhaps with the floating rising interest rate, and almost certainly we'll see the interest rates bump up a little bit more here. They've already gone up more than we've seen in recent history here in just the last 4 or 5 months, and they may do so again. How do you mitigate that, Warren? Well, you buy a rate cap, and that's an insurance policy, meaning that if we hit the limit of our rate, the insurance company begins to pay the difference in the interest. And we'll do that for years 1 through 3 in this case to mitigate that. The interest rate continues to go up. What happens if interest rates continue to go up? How does that affect our ability to refinance or sell in year 3? Well, there's not any way for us to know. I'll tell you, though, that if you listen to the pundits here now and reminded that we have a little bit of a bias to listen for the information that agrees with what we want to hear and maybe not what we think we need to hear. But a lot of the folks that I'm listening to explain that whichever political party, as we get closer to the presidential election here in 2024, the political party in power right now in Congress and in our White House is not going to want to go into that season with rising interest rates. They're going to want to do something to ease the recession and the impact on those voters. That bodes very well for us in a couple of ways. Rising inflation means that the money that we borrow today, we are actually paying back with lower value dollars, which means we're essentially getting a break. We're actually making money by borrowing money today in a rising interest rate economy. The additional benefit of that is as interest rates go up, fewer people are going to want to purchase a home. They're going to want to rent to ride this out. And as they do that, that means then that you can continue to improve rents, particularly in places like Oak Lawn, which is highly desirable, and it's in an irreplaceable location. They're not building new B-class properties in Uptown Dallas or in Oak Lawn. So this has become a highly desirable place to live, remain highly desirable. Higher rents mean higher NOI, and if the cap rates remain stable, or even if they go up a little bit, and we've incorporated that very conservatively in our underwriting, you'll find that the value of the property is actually going to continue to grow, even as inflation goes up and interest rates go up. So there's benefit to this, but with the possibility that they will curb that interest rate growth or interest rates going up in time for the elections, which is right about that 3-year window for us to maximize returns on one of our exit strategies. So there's actually a silver lining in this dark cloud that the economy presents us right now, rising rates and rising inflation, but the possibility of a recession actually benefits those that are investing in commercial real estate, specifically rental properties like apartments. Next slide, please. So what's our timeline look like right now? Our business timeline, the purchase agreement was signed on 20 May. Due diligence was completed on the 10th of June. And we find ourselves here now conducting the investor webinar, and we start our subscription period here today as well. Our expectation is that we'll complete the subscription period on the 27th of July. That means all investor subscription paperwork will be completed and your funds wired to us. So we're able to move comfortably into that last week and target that closing date of 11 August. Next slide, please. When you invest with us, you should expect monthly reports from us. And those monthly reports will include all the financials, trailing 12, general ledgers, the bank balances, even the rent rolls. So you can go through this with as much detail as you choose, or you can use the condensed version of our NOI discussion and our discussion about the progress of our business plan and of our capital expenditure projects that we have, because we're going to explain those to you on a monthly basis. We expect to do quarterly distributions after the third quarter of ownership. Warren, why are we waiting 3 quarters before we start the distributions? Well, we've got to get our property management team on site. They need to get their feet underneath them. They need to begin to get some traction. And then we need to begin to see the implementation of our business plan to get some traction as well. Because remember, our business plan and those distributions are predicated on higher rents. And it's going to take a little bit of time to start to do that. So in about 3 quarters, 9 months, we expect that we'll do quarterly distributions. And we will always, always, always be very transparent about what we're doing on the property and any questions that you have. The best news in this, and I don't know how many other investment vehicles, how many of you that own Enron stock were able to call Kenneth Lay and ask him about research and development? How many of you have called your broker that actually invested in the same portfolio that they put together for you and have all your questions answered about the budgets and where the investment is going? But you've got a bevy of co-sponsors here, and the trusted co-sponsor that brought you here tonight that's always available to you in the form of text messages, phone calls, or emails. And we're going to communicate to you on a monthly basis to let you know what's going on with your investment. Next slide, please. I'm very excited about this opportunity. And why is that? Because Rebecca and I are investing right alongside you. We're going to have 6 figures invested in this property because it's going to have strong returns. We're very impressed with the projected returns, even in the current economy, because I think we have the right loan vehicle to still get pretty good returns, solid returns, despite what's going on with inflation and the possibility of recession. Rebecca and I have done a bunch of deals here in Texas, and we've done 3 specific deals as GPs in the Dallas-Fort Worth area. And we love working with the contractors here. We know who they are. We've got quite a bit of experience, and we'll leverage the experience of the other co-sponsors, John, Michael, and Denise, to bring you the best returns that we possibly can. And we will collaborate very closely on asset management to make sure that our property management team stays on track. We've got a good bridge loan, the terms on the bridge loans. We've got a pretty healthy rehab budget, and we have a good plan for what it is that we need to do with this property. We're in one of the best markets, man. There's not very many places that are outperforming Dallas-Fort Worth, and we're right near downtown and all the things that Rebecca presented to you. This is a great location, a great property, and it's in great shape. A very conservative underwriting. We've got a good business plan. The business plan, as I've mentioned, has taken into account that there's likely going to be higher interest rates. There's likely going to see some more inflation here before we arrive at the end of our business plan. And I think that whatever political party prevails in the next presidential election and even the midterms here now, they all know that real estate investing is a big buoy to the economy. They're not going to leave us behind. So this is a great opportunity in a great place with a great team. I think you do very well to invest in this property. So how do we invest? This is the part in the webinar here where we need to talk about how it is that you begin the subscription process. You can see evidenced on the left there, our minimum investment is $75,000. Obviously, you can't click here on the webinar. So what we provided you on the right are 3 QR codes. And each of those QR codes will take you to the appropriate co-sponsor, the one that brought you to the webinar here tonight. Please click or take a picture of the QR code and then click appropriately, you'll see for Michael and Denise on the very top there for Westward Invest. For Rebecca and I, it's Starboard Equity in the middle there. And then for John, Ari, and Jerry, if you please click on that third QR code after taking a picture of it. It'll bring you to the cash flow portal, where you're going to be given some options there to either sign in if you have an existing account, or sign up if you're a new investor with one of the cash flow portal. You'll get right into the subscription documents, an investor suitability questionnaire, and then eventually it'll end up with the wiring instructions for how you can fund your investment. All pretty simple, and I think you're going to find the cash flow portal experience to be a pretty easy one. If you have any questions whatsoever, you can see we have the numbers there too. Take a screenshot of this. Certainly, you probably know how to reach out to your co-sponsor. We're all prepared to help you through the process, and it is pretty straightforward. Great proximity to a lot of infrastructure, a lot of nightlife, a lot of work, and the workforce is absolutely working here. These are not the remote workers that are working from their homes. These are folks that are going into the work, going into the job sites, and they need to live close to those job sites. And this location absolutely affords that. It's right in the middle of everything that's going on in Dallas. I ask John to unmute now, and so we can move into the question and answer period here.
Sorry about that. Thank you, Warren. All right, so that concludes our webinar session. We wanted to leave maybe about 15-20 minutes for if you have any questions. Please feel free to type in your questions into the chat box, and myself, Warren, and the team will be able to take your questions and answer them accordingly. So feel free to ask away.
So while we're waiting for a question here in the chat, we did reach out to 2 other vendors for cost segregation studies. We've got some very preliminary reports that have come back, and they've actually been pretty close to the 63-64% of bonus depreciation in year 1 that we got from our first vendor. But I also have gone through those reports extensively with each of the vendors, and they all admit that they've given a pretty healthy percentage to land because it's most conservative. So they don't want to overpromise and then underdeliver, so we won't do the same. Right now, we're looking at about 64 to 65% year 1 bonus depreciation. That's still a hell of a lot better than none, and particularly when this is the last year that 100% will be available. Again, in 2023, that drops to 80%, and then 20 percentage points decremented each year until either the program's replaced or that opportunity evaporates.
Thank you, Warren. Any questions? We did such a good job. There's no questions. We have one question from Jeff. Would you please provide more detail about how you are modeling interest rate increases? Yeah, I can take that if you guys are okay with that.
Yeah.
Okay. So Jeff, what we did was so for interest rate increase, so our current mortgage, it's a floater. So it's a floater that has it's a 410 bips over term SOFR, and the term SOFR currently is about 1.5 basis points, 1.5655, somewhere around there. What we're planning to do is within the next 2 to 3 weeks, we're planning to actually buy a rate cap of 1.5 strike. So what that means is our maximum rate for the first 3 years at least is going to be capped at 5.6% to 5.7%. That's our maximum interest rate for the first 3 years of payments, of interest payments. And within that 3 year, probably within the last year of the 3rd year, we'll most likely reevaluate at the time in terms of what the rate environment is, or what the economy is around, how it looks around that time. Most likely we'll be refinancing into agency debt. And with agency debt is, if we do refinance, there's going to be a cash out. And also the agency debt is actually a much lower rate, compared to a bridge loan. And at that time, the rate could be 5%, could be 4%. We don't know what the rate is at that time. But yeah, so that's how we actually sort of model out our interest rate increase for the first 3 years. We essentially cap it at 5.61 to 5. Yeah, right now the base case scenario, we cap it at 5.61% for about 3 years. And so that's how we sort of model in our cash flow projections. So I don't know if that answered your question.
But hopefully it does. Nice to see you here, Jeff. Jeff has been in Sunrock for years and years and years and years.
Thank you.
All right, great. Looks like we did an okay job. Anybody else? Any random questions? We're happy to answer. Well, I think this tells us that our webinar did pretty well at answering some really great questions then.
Yep, definitely. Oh, Jeff also has another question.
Great.
Can you elaborate on your experience with this particular property management company? Yeah, so we actually, I can share a little bit about my knowledge of now, Jeff, are you talking about the current management company with the property, or are we talking about Fairmont, the property management company that we are engaging with?
I'm guessing with Fairmont.
Oh, the one you use. Okay, I see. Okay, perfect. So, this I can share a little bit about my knowledge of Fairmont and working experience. So, Fairmont Management Company actually was the management company that managed this property prior to current ownership. So they have been managing this property before the current ownership for about probably a good 8 years before the current ownership. So what we actually did was when we actually was looking at this property, we did a little bit of a research in terms of seeing what the current management, who the current, the current property manager of the current owner is actually owned by the ownership company currently, the sellers. So we actually did a little bit of research on Fairmont, and actually got highly recommended by a colleague of ours that's also in the multifamily business, that have probably 8 to 10 properties managed under Fairmont. And actually they happen to be the prior management company that used to manage this property specifically 3 or 4 years ago. Yeah, so that's one of the biggest reasons why we chose this management company.
Yeah, and so let me piggyback on that, Jeff. Fairmont, well, let me start it this way. Maverick is currently run by, oh gosh, what's it called again?
Allied Property Management.
Allied. Jeff, what I was going to say is Kenny Wolf's property management company. And so they'll be moving on with them. Kenny Wolf does not own Maverick right now, but Kevin Parrish owns Maverick right now. And so they'll be moving on with them. So with Fairmont, again, many of the other coaches and other folks that we know have used Fairmont and recommended them. And yes, we understand also that they're growing at a big pace right now too. But since they had managed it before, we felt that they knew the property, they knew the area and understood it well. And so that's why we're going to give them first dibs.
Perfect. Thank you.
So great question.
Thank you. One thing I do want to bring up is the property tax estimates. So prior to engaging, as you all know, property taxes in Texas is pretty pricey. And prior to engaging this property, or actually while we're bidding for the property, we did engage in Mark Contrell and Associates. They're a property tax consulting firm who can actually represent and assess and actually fight for you in terms of the property tax assessments on a yearly basis. So prior to actually within the underwriting, what we did was we actually factored in the yearly property tax increases according to Mark Contrell's estimates. Usually those are pretty darn close estimates from our from the actual numbers. So those have been baked into to the cash flow as well. So just wanted to address that in case that was a question.
You know, John, that's a really great topic that you brought up. And considering the fact that many of our investors are there in California, and I know I have a friend there in Ohio that they might not know about the Texas protest of taxes. So let's talk about that for just a moment. In that here in Texas, if you don't believe that the tax assessor has the right assessment of your taxes, you can then protest that. And we like to do that on our properties every single year, so you can fight to get them reduced. And so that's what John is talking about, that not only has he already got a person in line to protest our taxes, but he has already put in our underwriting approximately right around the $5,000 mark to have these folks protest our taxes every single year to keep them at a reasonable amount. So good job. Thanks, John.
Thank you. Jeff also has a question in terms of what will be the roles of the different individuals on the sponsorship team post-closing?
Great question.
You want to take that, Rebecca, or I should?
Yeah, no, I'm happy to. So yeah, we're thrilled, Jeff, that John and Denise and Michael and everybody asked us to come on as part of the co-sponsorship to help shepherd them on all, on everything that we've known since we're kind of the old folks here. Warren looked at me like, what you talking about?
Experienced folks.
Yeah. So Warren and I have been doing this for a while. So again, Denise, Michael, and John, they know what they're doing, but we've got a couple other, buildings under our belt. So we will, so we'll definitely be helping half and half with Denise and Michael on the asset management. John and Michael and Denise, as you already know, they are financial wizards. And so they did the primary part of underwriting. They acquired this building. They were able to acquire the lending. They worked with the lawyers. They worked with the insurance. They were able to get our friend Aaron Kelso with the insurance. They did the groundwork. But also, since Warren and I are here, boots on the ground, we're near the property all the time. So that will be our role.
And
You want to elaborate on that?
Oh, and then post-closing, on a yearly basis, any kind of tax preparation. I will be working with our CPA on preparing K1s or preparing monthly financials or quarterly financials with the help of the property management team. So that's also what I will be how I will be helping post closing.
Yes, and Denise and Michael are going to be doing the monthly communications with the investors. And so they will be mainly the point of contact, as well as John. And of course, you can always reach out to us as well, but they will be doing the communications.
Thank you for that question.
Yeah, great one.
All right. Any other questions?
All right.
All right. I think that's it.
Okay.
Please
Perfect.
do be sure if you have a question, you think of something later. We're going to make this, I believe we're going to make this available, the recording. So
Yes.
you have access to the slides, and it might spark a question or a conversation you'd like to have with any one of us. We do mean what we say about transparent communications. Please give any one of us a call, send us an email, or chat us in a text or what have you. We're happy to get the answers to you. What I've learned with Rebecca over the years is we answer investor questions, we become better co-sponsors. So send us your tough questions, send us the questions that dig into the PPM. One of the things I'll caution, most of your questions will be answered by the private placement memorandum or the PPM, which you'll see when you get into the investor portal. And one of the things I've learned is that when the lawyers are telling you stuff that's legal speak, they put it in all caps. But in that document, you'll find answers to many other questions that you didn't even know you had. When you get a chance to go through that, if you just need us to break some of the legal speak, please reach out to us, because over many years now of reviewing PPMs, we've gotten pretty good at it. All of us have. The company agreement, the subscription agreements, we can break this down for you very easily. So don't spend a lot of time trying to figure it out by yourself.
Perfect. Thank you so much, Warren. Really appreciate it. Oh, actually, Adam, I found some other questions. Sorry. Adam Saluk said that are 1031 exchanges available to LP at the sale of the property? So Rebecca and Warren, correct me if I'm wrong. I think when you are a limited partner on a syndication like this, you usually cannot 1031 exchange your shares into another property, right?
If we go into the PPM again, and this is classic PPM stuff. The
Okay.
private placement memorandum actually has a paragraph on there, and in there the attorneys at Callister, they just do securities. This is all they do, and we've done a bunch of deals with them, and they pretty plainly will tell you in a 506B like this that we're not permitted to receive 1031 exchanges on the purchase of this property, but it is negotiable, however difficult, on the sale of the property. So we'll dig into the PPM in detail and make sure that it says that pretty plainly in there. To John's point, you don't normally do that from a 506B, but it does give us the provision that as the ownership, if we agree, the majority agrees that we want to take the time because it's difficult to accommodate, but I do think we have the ability to do that on the sale. It's just not normally done for these types of securities.
Thank you, Warren. And Ken and Sherry Devine mentioned and said that honestly, the team had a great presentation, probably why there are not many questions. Thank you. Thank you. Really appreciate it.
So we got to be honest. Those are family members and they're plants for us. They were supposed to say, Warren looks great, not old. And you guys did a great job here tonight. So thanks, Ken and Sherry, for dialing in with us. Very much appreciate that. But they are potential investors.
Yes,
They're very
they
interested in this deal.
Oh, awesome.
Okay, everyone. Well, thank you
Thank you so
for
much.
being with us
Really appreciate
tonight.
it. Yeah, thank you for being with us. And we'll be sending out the recording of the seminar post the session today. And thank you again for your attendance. Thank you very much.
Good night, everyone.
Bye-bye.